Think of the risk range like I've been using every metaphor that I can, but again, if you've never gone ice fishing, think of the risk range, if you're walking out onto the ice, the end of the ice, where there's water after that. So when you get out to the end and you want to keep walking, you better believe either that a helicopter picks you up, scuba guys are around, or that you can walk on water, okay? So the risk range is really important because it tells you how far out you are on within the spectrum of risk. And that's what I call risk, is when you get out to a place that you can't keep walking. So think about that. If you're not an ice fisherman, you're going to be like, what is this guy talking about at this point? But I could put this in any metaphor that you possibly can. If you want to walk, you try it in New York City. When the light is red, try walking out in front into the traffic and see what happens. If the light is green, okay, then that's fine. If the light is counting down when it's going to go red, then this is where we're at when we think about counting the risk range. There's a lot of people that count days. I mean, Tom DeMark has become famous for counting days. All due respect, but we can count them too. Exhaustion is how he thinks about it. I think about exhaustion on the upside. That's how I measure it, in as much as a downside. By the way, I model things, some things like he does. I'm complimenting him, by the way. So again, use the risk range. And again, when the risk range is widening, that's a big leading indicator for volatility. Most people would say that's bad unless you're short the market. But again, rising risk range equals, again, widening risk range equals rising probability of volatility coming. And when that happens, that's why I would write something like I did this morning, which is, if anything, if you're going to have a collapse, it would be like imminent. We're at the widest point all year long, by the way, and that's an important point.